Welcome to the Stock Market Palantir. Today we are going to talk about Micron Technology, Inc. It's trading near $236 a share, and it really represents one of the most explosive and I think debated stories of the 2025 market. This stock has rallied, approximately 174% year to date, driven almost entirely by the structural demand for AI infrastructure. The question we need to answer today for any serious investor is, it's fundamental. Is this staggering valuation actually justified by Micron's technological supremacy and its strategic market position? Or is the rapid, almost vertical appreciation primarily a product of complex, high-velocity market plumbing, things like dark pool accumulation and high-leverage retail options flow?
That is indeed the essential point of divergence. And I see why you want to anchor the discussion in that fundamental story. But the sheer velocity and, as you said, the nearly vertical trajectory of this move, it just suggests to me that market mechanics are currently the dominant force. They're the actual engine driving the price far faster than earnings expectations can possibly accelerate. I'll be arguing that while Micron's core business is, it's undeniably strong and the HBM thesis is compelling, the price surge is predominantly fueled by non-fundamental elements. Specifically, the options flow mechanics, the resulting gamma squeeze effects, and institutional accumulation that, and this is crucial, masks the underlying complexity and potential structural risks inherent in such a rapid ascent.
And I'll be taking the opposing view. My position is that the valuation is fundamentally sound. What we're witnessing is the definitive, long-awaited decoupling of Micron from its painful historical classification as a cyclical commodity stock. This is now a secular growth engine powered by the AI supercycle, and the market mechanics you're citing are merely reflecting, and maybe accelerating, a legitimate, profound fundamental revaluation. Look, Micron has achieved a status as a critical pillar of the AI economy. It's not simply another commodity manufacturer beholden to the whims of the PC or smartphone cycles anymore. The core driver is the supercycle demand for high-bandwidth memory, specifically the high-performance HBM3E modules. Let's be clear about the physics here. AI accelerators, particularly the top-tier units coming out of NVIDIA's pipeline, are functionally useless without massive, dedicated amounts of ultra-high-speed HBM. Micron successfully ramped production of its HBM3E, offering a significant advantage, reportedly 30% lower power consumption than key competitors, and immediately establishing itself as a key supplier in what is, essentially a duopolistic market. Crucially, we have verifiable reports that their HBM capacity is effectively sold out through late 2026. This is the critical piece of evidence. This supply-constrained environment grants them massive, sustainable pricing power and ensures a rapid expansion in gross margins that is structurally locked in for the next 2 years. The entire investment thesis has shifted to secular growth, and this is validated by hard supply chain signals. When we hear global OEMs like Dell and HP citing rising memory component costs as a significant headwind to their own profitability, that is proof positive that vast profits are being transferred directly from the downstream consumer to Micron's balance sheet.
Okay, I acknowledge the power of the HBM thesis. The shift from cyclical to secular is the necessary narrative foundation for the current price. I won't argue that. However, I come at it from a different way, which is to look at the engine of appreciation rather than just the fuel. While the fundamentals provide the reason to buy, the actual mechanism driving the stock to 236 and beyond is market structure and speculative fervor, which is inherently volatile and unstable. We need to look at the trading data to understand why the price has moved so far so fast. We observe that a staggering 40 to 45% of trading volume occurs in dark pools, private exchanges that shield aggressive institutional accumulation, what we term markup accumulation, from public view. This practice, it disrupts organic price discovery. Simultaneously, we have retail sentiment, particularly fueled by platforms like our Wall Street Bets, which has transformed MU into a vehicle for high-leverage YOLO options trading. This collective mass buying of short-dated call options creates powerful, self-reinforcing mechanical effects. The resulting gamma squeeze accelerates price moves that are functionally disconnected from any hourly news flow. If the price is too highly correlated with market mechanics designed to absorb liquidity and encourage speculation, it potentially conceals a dangerous valuation risk beneath all the excitement.
I see why you zero in on options flow as a source of instability. I agree that options create mechanical volatility, but that volatility would be unsustainable. It would be short-lived if the underlying thesis wasn't structurally solid. The retail community's embrace of Micron as an AI leader isn't just pure speculation. It is a rational recognition of the linear, evidence-based NVIDIA correlation trade. The logic is clear and powerful. The more capacity the AI ecosystem builds, the more high-speed memory it absolutely needs. The enthusiasm you call AI fundamentalism is a genuine response to a powerful evidence-based thesis. If the stock is a bona fide pick and shovel play on the biggest technological wave in decades, the retail buying is simply confirming a trend that institutional money initiated.
I think you're underestimating the mechanical power of speculation when it reaches a certain threshold, though. That enthusiasm is being actively amplified into dangerous speculative territory. Look at the culture around it. The use of gain porn, those brokerage screenshots. It acts as viral marketing, driving fear of missing out or FOMO, and setting these unanchored moon targets that massively overshoot any realistic analyst consensus. Even if we use the most aggressive street high target, something like the $338 projection, retail discussion far exceeds that. This high-leverage options flow creates what I call the shadow whale effect. The price movement isn't driven by the fundamental desire of investors to own the underlying shares for 2026 value, but through the continuous mechanical hedging obligations imposed on market makers. When a massive amount of call options are purchased, market makers find themselves short gamma. To mitigate their risk, they must mechanically buy the underlying stock as the price rises to maintain a delta-neutral position. This creates a vicious, self-reinforcing mechanical loop that accelerates the price entirely divorced from any immediate news cycle.
That's a crisp explanation of the gamma squeeze. But you're treating market makers' hedging obligations as a structural defect when they are simply a function of high demand for leverage reacting to a positive catalyst. Furthermore, your argument about retail pushing the price overlooks a structural factor that has eliminated the natural counterforce: professional short selling.
That's an interesting point, though I would frame it differently. The visibility of what retail traders call loss porn, the public documentation of those who tried to short MU and were, violently squeezed out, that actively discourages any sophisticated contrarian short bets. This eliminates the natural checks and balances of the market. Without that necessary selling pressure from professional bears who disagree with the valuation, the rally can extend far beyond what any fundamental model would predict, simply because the natural liquidity absorption mechanism has been scared out of the market. The resulting price stability is artificial because all the selling interest is met with either options-driven buying or this opaque institutional absorption. And speaking of opaque institutional absorption, let's shift focus to where the truly coordinated institutional money is moving. I want to emphasize the quantitative evidence regarding institutional behavior. The fact that the off-exchange ratio, the percentage of volume trading away from public exchanges, consistently hovered between, 40 and 46% in late November, that signals institutional activity focused on impact minimization and information asymmetry. They are focused on executing large volume orders without alerting the broader public market to their aggressive buying interest, thereby preventing the price from running away from them before they accumulate their full position. This opacity has a profound market effect. Dark pools create a soft floor under the price. By absorbing large blocks of selling pressure anonymously, they prevent the public exchanges, the lit exchanges, from registering those large blocks of sellers. This is the mechanism that explains why pullbacks in Micron have been consistently shallow, that selling is being soaked up off exchange, effectively masking true distribution risk and driving the price higher in a controlled, non-transparent manner.
That's a compelling argument regarding impact minimization, and I acknowledge the high off-exchange ratio. But I would frame it differently. The sustained high dark pool volume is actually a marker that MU has achieved blue chip status, much like how NVIDIA or high-growth defensive names trade. Large asset managers, mutual funds, sovereign wealth funds, they simply cannot deploy billions of dollars onto the public lit exchanges without triggering precisely the kind of price instability they are mandated to avoid. Therefore, this sustained high-volume off-exchange is the market telling us that Micron is now a consensus, high-conviction holding for the world's largest pools of capital. It signals institutional faith in the secular growth story, not merely a technical distortion. Furthermore, analysis of the short interest is key here. It remains stable and extremely low at just 2.45% of the float. If institutions truly believed this price surge was unsupported market structure hype, we would logically see a massive buildup in professional short positions waiting for the inevitable mean reversion. The fact that the bears have exited is crucial evidence that the fundamental premise of the AI supercycle is accepted. And technically, the previous resolution of large fails to deliver FTDs that spiked back in October required forced buying to clear those failure obligations. That mechanical clearing action acted as a hidden tailwind in early November, essentially cleaning up the technical overhang right at the start of the institutional accumulation phase you're discussing. The structure merely helped facilitate the start of a fundamentally necessary rally. Let's turn back to hard, verifiable corporate actions that underpin this revaluation. I want to address 2 points of stability.
First, the forensic analysis confirms that Micron Technology, MU, has definitively never executed a reverse stock split. This corrects the common conflation with the microcap Micron Solutions, MICR, which did a 1 for 1,000 split last January. This historical clarity, it signals management confidence. Most importantly, we have to discuss geopolitical alpha. Consider the $3.3 billion Japanese government subsidy pledged for the Hiroshima fab expansion. This action provides massive financial and strategic benefits. It de-risks approximately 1/3 of the entire projected capital expenditure, dramatically enhancing the projected return on invested capital, or ROIC. This isn't just a handout, it's a strategic move that provides geopolitical alpha by shifting critical manufacturing capacity away from major Taiwan and China hotspots.
This insulates Micron from regional trade disputes and increases supply chain resilience, a long-term fundamental de-risking that's being baked into the stock. And frankly, warrants a higher multiple.
Okay, I agree that the Japanese subsidy and the corrected historical clarity regarding the reverse split myth, those are strong points for corporate stability and strategic positioning. However, I just don't buy that these long-term stability factors justify the magnitude of the rally right now. The market is fully pricing in these future benefits prematurely. The high valuation is almost entirely predicated on highly optimistic 2026 earnings estimates tied to HBM supercycle adoption. This valuation leaves almost no room for error. I mean, if the rate of AI supercycle adoption falters even slightly, or if competition from rivals like SK Hynix or Samsung heats up faster than anticipated in the HBM space, which is a brutal, high-capex business, the current valuation is extremely vulnerable. Furthermore, you mentioned geopolitical de-risking, but the market seems to be dismissing real, current regulatory risks, such as U.S. export controls that led to Micron stopping server chip supplies to certain Chinese data centers, while the market cites fungibility, that U.S. hyperscalers will instantly snap up the supply. The extremely high valuation makes dismissing that regulatory and revenue risk a far riskier calculation than it would be at a lower, more fundamentally grounded price point. The structural acceleration of the price has simply run ahead of certainty. It's pricing in perfection.
But that is often the necessary characteristic of a company leading a genuine secular supercycle, right? The certainty for investors is the long-term adoption curve of AI, which we know demands HBM. The market isn't pricing in marginal growth, it's pricing in a systemic transition. Dismissing the near-term risk of competition is rational when Micron holds a documented technological lead in HBM3E power consumption and has already secured those critical 2026 supply commitments. The fundamental picture is so strong that sophisticated investors, both large and small, are willing to accept the higher multiple because the growth is perceived as non-discretionary and mission-critical. To summarize my position, Micron's current status and valuation are driven by an unassailable technological lead and, for the moment, a critical supply monopoly in the necessary HBM3E modules. This is coupled with strategic government backing,
that dramatically reduces capital risk.
The complex market structure dynamics, you've highlighted the options flow and the institutional volume, while influential, are ultimately confirming a legitimate and powerful fundamental revaluation of the company as a true secular growth leader.
And conversely, I reiterate that the incredible speed and sheer magnitude of this rally are demonstrably influenced by market structure forces. Specifically, the intense high-leverage options flow creates mechanical volatility, and the opaque institutional timing facilitated by dark pool trading absorbs selling pressure in a non-transparent way. Investors must appreciate that the stock's stability and its near-term trajectory rely not just on its earnings power in 2026, but on the sustained mechanical forces that are currently absorbing liquidity and fueling retail euphoria.
So the complexity of modern markets means the reality of a stock like MU is defined by the tight intertwining of fundamental performance, the strength of the HBM thesis, and these structural dynamics.
Absolutely. We have explored whether Micron's staggering 2025 rally is primarily a function of its fundamental dominance in HBM3E and its geopolitical strategy, or whether it is more closely tied to powerful, opaque forces operating in dark pools and the high-leverage options market.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.